Hello, everybody. Welcome to class number 6 of the Opus Monetae program. In our last lesson, we covered a critical part of a financial plan, putting together an emergency fund. We also discussed several types of accounts you may encounter at banks and credit unions. In this lesson, we're going to dive into some very important aspects of protecting your deposits. Let's get right to it. An important thing to consider when opening an account at a bank or a credit union is to make sure that your deposits are covered under a deposit insurance program. What's deposit insurance? Well, let's step into a time machine and take a trip back into history. Prior to the 1930s, banks and other financial institutions were not well regulated by the government. A lack of adequate government regulations made banks very risky for people who stored their savings there. To explain this risk, let's first discuss how banks earn money. A primary way that a bank earns money is by taking the cash you deposit and then lending that cash to borrowers who are seeking to take out a loan. The interest that they charge to borrowers on a loan is revenue to the bank. The interest that they pay depositors for savings is an expense to the bank. Therefore, in order to turn a profit or have net income, the bank aims to pay depositors a lower interest rate than what they are receiving from borrowers for loans. The difference between what banks pay depositors and what they receive from borrowers is called spread. The spread is one of the primary ways a bank earns money. Let's look at a very basic example. Let's say that a bank pays you 1% interest for the $10,000 you have in your savings account. Now, let's also assume that the bank makes a loan to a borrower for $10,000 but charges 7% interest on the loan. The 6% difference is essentially net income or profit for the bank. Okay, great, Rob, but what does this have to do with protecting my deposits? Well, there's another important component that banks need to consider during this process, and that's called risk. Making loans involves risk. If a borrower is unable to repay their loan, the bank will normally have to take the unpaid amount as a loss. To defend against this risk, the bank will hold a certain amount of assets in reserve to cover this loss. Just like you have an emergency fund for yourself, a bank has one too. The government enforces a number of rules to ensure that banks have reserves, also called capital reserves. Unfortunately, it wouldn't be practical for a bank to hold reserves to cover the potential that too many of its loans fail to be repaid. While this more serious event is rare, it can happen. Remember Murphy's Law from our last class? If losses start occurring at a high rate, say during a poor economic period like a recession or a depression, we'll cover what these mean later, then banks could find themselves in a very difficult situation. If a large number of borrowers are unable to make their loan payments, depositors may start to worry that they won't be able to get their deposits back. When this fear spreads among a lot of depositors, you could see a situation called a bank run. A bank run happens when fear spreads rapidly, causing many depositors to suddenly withdraw their money from the bank, and the bank is no longer able to honor the withdrawals. If a bank is unable to honor withdrawals because of losses from loans, then you have a situation called a bank failure. The bank has failed to protect depositors' money by making loans that are not able to be repaid. Bank runs and bank failures are terrible events that shake the economy to its core. Banks play an important role in the economy because they essentially create credit or the ability to lend money, which is then used to help fund economic activity. Bank runs and failures devastated the country prior to 1933. Many ordinary folks lost their entire life savings during these events, which became a major contributor to the Great Depression of the 1930s. To combat the risk of bank runs and bank failures, President Roosevelt created the FDIC, or Federal Deposit Insurance Corporation, in 1933. The FDIC is an independent agency created by the federal government to insure bank accounts in the event that a bank fails. A bank must be a member of the FDIC for its depositors to qualify for this insurance. The insurance program works like many other insurance programs. Each member bank pays the FDIC an annual fee, and that fee goes into a large insurance fund that is used to pay back depositors in the event that a bank fails. The FDIC insurance fund isn't the only government mechanism that protects depositors. There are many other regulatory tools in place to protect against bank failures, like those capital reserve requirements we discussed earlier, many of which came after the financial crisis of the late 2000s. We'll talk about financial crises later, but for now, know that if you're going to use a bank, it's critical that you use one that is FDIC insured. Your next question may be, how do I know if I'm using an FDIC insured bank? An insured bank, also called a member bank, is required to physically display an FDIC placard or sign in each of its branches to indicate that it is in fact FDIC insured. If you are ever unsure, you can go right to the FDIC's website and search for any bank to see if it is, in fact, FDIC insured. Another important question is all of your money insured, or are there limits? It's important to note that you are not automatically insured for any amount you deposit at an FDIC insured bank. There are limits as to how the insurance program works. The first important distinction relates to account types. Checking accounts, savings accounts, money market deposit accounts, high yield savings accounts, and CDs held at an FDIC insured bank qualify for insurance protection. On the other hand, stocks, bonds, mutual funds, life insurance, annuities, municipal securities do not qualify for FDIC insurance even if they are purchased through an FDIC insured bank. Additionally, safe deposit boxes are not covered by FDIC insurance. A safe deposit box is a lockable box located within a bank's vault that a person can rent and keep valuables in. It's not a good idea to keep your emergency fund stashed in a safe deposit box. For a complete list of accounts covered by FDIC insurance, visit the FDIC website at fdic.gov. The second important distinction relates to how much is covered. There are dollar limits as to how much of your money is covered by FDIC insurance. As of the date of this video, FDIC insurance covers up to $250,000 per insured bank per ownership category. That's a lot of words, so here's what it actually means. There are numerous different types of ownership categories that the FDIC will separately apply the $250,000 limit to within a specific bank. Two of the most common types of ownership categories are single, meaning the account is in your name only, or joint, meaning the account is in the name of yourself and someone else, like your spouse. Let's assume you have $500,000 deposited at a bank called First Shield Bank, which is FDIC insured. You have $250,000 in a single account and $250,000 in a joint account with your spouse. All of this money is covered by FDIC insurance, since the $250,000 limit applies to accounts per ownership category. However, if you had $250,000 in one single savings account and $250,000 in a separate single checking account at the same bank, only $250,000 of the total $500,000 would be covered, since both accounts are at the same bank and both are in your name only. If you want to have $500,000 total in FDIC insured accounts, you could open a single account at one bank and keep $250,000 there, and then open a single account at a different bank, not a different branch of the same bank, and keep the other $250,000 there. It's also important to note that if you have one savings account at an FDIC insured bank with a balance exceeding $250,000, your account is still insured, but only up to the $250,000 limit. Another question I get a lot is, what are credit unions? And is my money safe in one? Credit unions operate very similarly to banks. However, there are some key differences. Credit unions are typically set up as non-profit institutions, meaning they don't have a goal to maximize profits like banks do. Credit unions are owned by their members in an entity known as a cooperative. Banks, on the other hand, are for-profit entities and are owned by investors. Since credit unions aren't concerned about turning a profit for investors, many are able to offer higher deposit interest rates, lower loan interest rates, and lower fees than a bank does. A bank isn't able to offer such great benefits to customers because they also have to turn a profit for their investors. While a credit union can still offer stellar benefits, there are some challenges with becoming a member of a credit union. Most credit unions won't accept anyone. Many restrict their membership to those who work in a certain industry, like firefighters, law enforcement, or the military and their families. So, it's certainly not a guarantee that you can join any credit union. Some credit unions, however, open their membership to the general public. If you're interested in joining a credit union, check out their website, give them a call, or visit one of their branches to see if you qualify. What about deposit insurance? Since credit unions are not banks, do they also fall under the FDIC deposit insurance program? Credit unions do not belong to the FDIC insurance program since they are not banks. However, there is another agency that runs an almost identical deposit insurance program for credit unions called the National Credit Union Administration, or NCUA. The NCUA insurance program operates like the FDIC program in that deposits in qualified accounts at an NCUA insured credit union are insured up to $250,000 per depositor per insured credit union. Similar to banks, NCUA insured credit unions must display the NCUA logo placard in their branches. You can also visit the NCUA website, ncua.gov, to verify that a credit union is insured. That's a lot of information, and I don't want you to feel overwhelmed. So let's stop here, and we'll finish up our lesson on managing cash in class number 7. Don't miss it, because we have a lot of important tips coming for you. Before we go, I have a very simple but important financial checkup for you to do for homework. Take a look at all the money you have in banks and credit unions. Verify that your bank is FDIC insured or your credit union is NCUA insured. And lastly, make sure you understand how much of your money is covered by these programs and make adjustments if you think you need to. Set a reminder to do this checkup at least annually or more often if needed. Feel proud. Your financial knowledge is building with every class, and we have so much more coming for you. If you have any questions at all, please contact me at opusmonetayquestions@gmail.com or comment below, and I will try my best to get back to you as soon as I can. Thanks for watching. We rely heavily on recommendations. Please follow us on Instagram, subscribe to us, and like this video on YouTube, and share our program with your family and friends. See everybody in class number 7. Peace!